So, if you or your clients are getting into prediction markets or crypto gambling, you're probably bumping up against a major tax compliance headache. Today, we're going to break down a whole new way of looking at this. We're talking about treating these wagers not as simple bets, but as dispositions of property. And trust me, that's a huge deal with some pretty serious financial consequences.
And this quote, it just nails it. That fissure they're talking about, that's the exact spot where the old tax rules, the ones designed for Vegas casinos, just completely fall apart when they meet things like prediction market contracts or bets made with crypto. The old playbook just doesn't work anymore. All right, so here's the game plan for this explainer. We're going to start by laying out the core problem. Then we'll build the legal case for this new approach step by step. We'll get into how crypto makes things even more complicated, and then we'll compare the actual real-world financial results of doing it the old way versus the new way. And finally, we'll look at the big regulatory change that's forcing this whole issue and give you a clear path forward.
Okay, let's dive right into the core idea here. This isn't just about picking a different accounting method. We're talking about a fundamental change in how we legally classify these deals. And getting this right is, well, everything.
So here's the bottom line. When your client is on a platform like Kalshi or Polymarket, they are not just placing a bet. Nope. They are acquiring and then getting rid of a contractual right, which is a piece of property. That means what they're doing looks a whole lot more like trading stocks than playing roulette. And it absolutely has to be reported that way on Form 8949.
Now you might be wondering, okay, but where does this idea even come from? So let's build the legal case for it. We're going to walk through 3 specific sections of the Internal Revenue Code that are basically the pillars holding this entire framework up. First up, we've got Internal Revenue Code Section 1221. It's pretty simple, actually. It defines a capital asset as basically any property you own, and then it lists out some things that aren't capital assets, like your business inventory or accounts receivable. Well, a prediction market contract, it doesn't fit into any of those exclusions, so by default, by the very letter of the law, it is a capital asset. This is the absolute linchpin of this whole argument.
All right, next up is Section 1001. This is all about the mechanics of how it works. It says your gain or loss is simply your amount realized, what you got for it, minus your adjusted basis, what you paid for it. So let's say a taxpayer buys some contracts for $400. That's their basis. Then those contracts pay out $1,000. That's the amount realized. Section 1001 says you've got a $600 capital gain. It's the exact same math you'd use for selling a share of stock.
But what about a losing bet? This is where IRC Section 1234A comes in, and honestly, it's brilliant. It says that when a right to property expires or lapses, it's treated just like a sale. So when that prediction contract expires and it's worthless, it's not like your money just vanished into thin air. For tax purposes, it's as if you sold that contract for $0. And that is what lets you report it on Form 8949 with zero proceeds and claim a capital loss for your entire basis. It's perfect.
Okay, so we've got the basics down for regular money, but what happens when we throw crypto into the mix? Well, that's where things get really interesting. This is what we call the inherent crypto event.
You have to remember, the IRS treats crypto as property, not cash. So when you use it to fund a wager, you're actually making a barter transaction. And this creates what we're calling the double disposition. The first taxable event happens the second you send that crypto to the smart contract. Boom, that's a disposition of your crypto. Then you get the wager contract, and its basis is whatever the crypto was worth at that exact moment. The second disposition happens later, when the bet finally settles. You've got to track both of them.
And this slide, wow, it just lays out the massive problem perfectly. On the left, you've got the wrong way. A taxpayer uses 1 Ethereum, which they bought for $100, to place a bet when it's worth $3,000. The bet loses. They report zero income. But they've completely missed the $2,900 capital gain they had on the ETH itself. Now look at the right, the correct way. Using Form 8949, you report both events. First, the huge gain on the crypto, and second, the capital loss on the expired wager.
Okay, we've gone through all the legal weeds, but what does this actually mean for your client's wallet? Why does this whole distinction matter so much when you get down to the bottom line?
This table really says it all. Look at the old gambling rules. You've got $60,000 in losses, but only $50,000 in winnings. That extra $10,000 in losses? It's just gone. Poof, vanished forever. And you have to itemize your deductions, which means you probably lose your standard deduction. Now, compare that to the Form 8949 method. Not only can you deduct a net loss of up to $3,000 against your other income, but that leftover $7,000 loss gets carried forward to future years. Oh, and you still get to take the standard deduction. The difference is just massive. For a long time, a lot of this activity has been flying way under the IRS's radar. You could kind of get away with it. But that is all about to change, and I mean dramatically. This isn't just a better theory anymore. It's about to become a practical necessity.
And this is the question, right? This is what everyone's thinking. Without a 1099 coming from these platforms, this all just feels kind of theoretical. How on earth would the IRS ever connect the dots?
Well, here's the answer. Form 1099-DA. There's a new law that's going to require brokers to start reporting digital asset deals. And the key word here, the thing you absolutely have to remember, is gross proceeds. They're not reporting net profit, they're reporting the total dollar amount of the transactions. This is the visibility that changes the entire game.
Let's use a quick example to see how this plays out. A taxpayer has a good run, makes a bunch of winning bets, and keeps rolling their money over. The brand new Form 1099-DA from the platform is going to report this figure to the IRS as their gross proceeds, $20,300.
But here's the thing. Their actual take-home profit was only $200. So you see the problem, right? The IRS gets a document that says $20,300 in proceeds, but the taxpayer reports only $200 of income. That is an automatic screaming red flag for an audit. And the only way to explain that massive difference, to reconcile the gross proceeds with the actual gain, is to file a Form 8949 where you can show both the proceeds and the cost basis that offsets it.
So, where do we go from here? Given this new reality, what do you, as a professional, actually need to do? Because honestly, mastering this is no longer optional. The single biggest headache here is what the source calls the data deficit. The CSV files and transaction histories you download from these platforms, they're just not built for tax compliance. They might give you a simple P&L number, but they almost never have the details you need for Form 8949, like when each contract was acquired and what its specific cost basis was. This means a simple profit and loss summary just won't cut it anymore. You have to follow a very specific workflow. First, you have to get the complete transaction history. Second, you have to literally reconstruct the cost basis for every single transaction using a consistent method like FIFO. And only then can you fill out Form 8949 with all the required details for every single sale. It's a lot of work, I know, but it's the only way to build a return that can stand up to scrutiny. So we'll end with this question, which is really the heart of the matter. Because with Form 1099-DA on the horizon, this isn't a theoretical debate for tax nerds anymore. This is reality. The IRS is going to have the gross proceeds data, and it's going to demand an explanation. And this wager as disposition framework, it's the only clear, legally sound answer to that demand.